Hello, everyone, and welcome to the latest LPL Market Signals podcast. Jeff Bookbinder here, your host for this week, with my friend and colleague, Lawrence Gillum. Lawrence, hope you enjoyed the weekend. Hope all of you did. Normally, I don't have a lot of exciting news to report on these podcasts to start the week, but it was a pretty busy weekend in the Bookbinder household. So we had birthday party for the wife, so hosted a bunch of people at our house on Friday, and then Saturday had a gymnastics competition. So humble brag, I got to share. My daughter Emily won first place in the all-around competition. So very exciting week for the Bookbinder family. How about you, Lawrence? How was the weekend?
It was a good weekend. Thanks for asking. The highlight of our weekend, at least from my perspective anyway, was the Bucks playoff victory last night.
Of
We're
course.
recording this on Tuesday after the playoffs. A little unexpected, but I'll certainly take it. A little tired today though because of that, but nonetheless pretty excited.
Well, I'm a happy Chiefs fan too. I should add that to the highlights of the weekend for me anyway. Not looking forward to going into Buffalo, but should be a good game. So here we'll look at these important disclosures first, and then we'll get into our agenda for the week. We're recording this on Tuesday morning, January 16th, 2024. So a little later than we normally do with the holiday. On Monday, we're going to start by recapping what was a very good week for stocks and bonds last week. We'll next hear from Lawrence on the muni market, which actually is of great interest, I think, to people. We get a lot of questions from investors on munis, so looking forward to hearing from Lawrence on that. Next, we'll talk about earnings season. It's been a little bit of a messy start, but it's so early with so few companies having reported that it's probably not worth drawing conclusions just yet. So we'll preview the earnings season, talk about our weekly market commentary for this week, which was just posted on LPL.com right before we started recording, and then finally preview the week ahead, which is a pretty quiet week. Retail sales and housing data, not really that top tier kind of data like we got last week with the inflation reports. So let's start with a recap of last week. So we've got a lot of green on the screen, so to speak, even though we haven't color coded this table. The S&P 500 was up about 1.9%. Last week, we have leadership from the big tech names. So you see here in the sector section here, tech up over almost 5% over the past week. Comm services, which is where Alphabet and Meta are, was up about 3.5% last week. So that was really, I think, the big story. But certainly not all that went up. We had pretty good gains from consumer discretionary. We had some gains in industrials. We had some nice gains in consumer staples as well. So I guess it was somewhat broad, but I think the big story maybe is big tech. And that's why you see such strong gains for growth over value. LPL research continues to favor growth over value. You've got some really good earnings power going on right now. That'll be evident in earnings season, which we'll talk about in a minute. We like domestic over international, but you have to just take note of the strong gains in Japan year to date. The Nikkei here is up 7% year to date. S&P is barely positive. So that's just a really, really strong start to the year for Japan, despite all the concerns about them tightening monetary policy at some point. So wanted to highlight that standout performer. So Lawrence, it was a good week for bonds too. The 2-year yield absolutely plummeted last week.
Yeah, a lot of the action in the fixed income markets, at least on the rate side, has been in the front end of the Treasury yield curve, which we'll talk a little bit about, I'm sure, in just a second. But it was a good week for fixed income in general last week. The aggregate bond index, which is the core bond index, almost up 1%. That was driven largely through the investment grade corporate index, as well as the mortgage-backed securities index outperforming kind of the, call it the lower rated categories within the fixed income markets. Plus sectors performed okay last week as well. High yield bonds up 1%. And then preferred securities, which is our preferred expression within the plus sectors, no pun intended there, up about 90 basis points or nearly 1% over the past week, up nearly, or I'm sorry, up over 10% over the past 3 months. So preferred securities is an area that we continue to like. These are these hybrid securities that aren't really bonds, they aren't really equities, but they do offer a pretty attractive yields and spreads currently. So we do have a slight allocation to preferreds, but by and large, our preference has been to remain up in quality with an allocation to a lot of these core sectors. So treasuries, mortgages, investment grade corporates. We have a slight preference to mortgage-backed securities, again, which they've done pretty well to start well, at least over the last week, over the last 3 months in particular. But where our view is that you're not getting paid to take on a lot of fixed income risk right now. So we aren't taking on a lot of fixed income risk right now. So we've been up in quality, and so far so good. It's been a good start to the year for a lot of these higher quality fixed income sectors, which we would expect to continue on a go forward basis as well.
Yeah, I think it's probably fair to say, Lawrence, you correct me if I'm wrong, after bonds had just that massive rally late last year, that maybe it makes sense to expect more muted returns, maybe a little bit of a bumpy ride this year. Is that fair?
Yeah, certainly over the course of the first half of the year, there's going to be what we call, a little consolidation within the rates markets. Spreads are that additional compensation for owning riskier bonds. Spreads are really pretty tight, so valuations are pretty unattractive currently. So that'll take time to kind of work its way through the markets. And I mean, I would expect the first half of the year to kind of be, blah, and that's a technical term, but maybe the rest of the action taking place over the course of the back half of the year, when we could see yields start to fall from current levels. But yeah, the last 2 months of 2023 were pretty impressive, and that probably pulled forward some returns, at least from the first half of this year.
Yeah, it seems like, every year you try to make a 12-month forecast, people are wrong, right? But at this point, I mean, we hope we're close. At this point, I actually would say I wouldn't be surprised if we get the same returns from the stock market as we get from the bond market, right? Maybe mid-single digits, maybe a little bit better. But of course, we've got a long way to go. The commodity side continues to be perplexing. Oil in the low 70s hasn't really responded to the attacks in the Red Sea and all the disruptions to shipping traffic there. So, that's a good thing. It helps support consumer spending with low prices at the pump. But certainly we see some upside risks to oil prices if that continues, and as demand kind of, catches up and maybe surpasses supply in the months ahead. Also want to point out on the dollar here, the bottom right-hand corner of this table, you see the dollar down 4% in the last 3 months. That really matters for earnings. So that actually is a reason to expect maybe a bit more upside to earnings in the fourth quarter than we might otherwise see. So here's the S&P 500 chart. Our technical strategist, Adam Turnquist, tells us breadth continues to hold up quite well. So you see that in the bottom panel, we've got 83% of S&P 500 companies above their 50-day moving average, which is still a pretty good number. 75% above the 200-day moving average. So, breadth is weakened just a bit, but is still pretty strong, and that's encouraging. We also have an S&P 500 only 13 points away from an all-time high. So we'll watch that closely. We're probably not going to get there today, Tuesday. Stocks are down a little bit this morning, but certainly we would not be surprised if at some point in the next several weeks we actually close at a new record high. Our target for year end is at the high end, 49.50. So that gives us a little bit of upside from here, not a ton, but if rates cooperate, we think maybe we can do a little bit better. Of course, that assumes that we get decent amount of earnings growth and something resembling a soft landing, which is generally priced into markets at this point. So Lawrence, here's the 10-year yield. I mean, here's that massive rally in bonds that I just alluded to. It looks like one of those sky slides at the amusement parks, some of those are a little scary to get on. You're not sure if it's going to hold up, but that's quite a steep drop. Then just a little bit of a bounce. So, what do you think the path of the 10-year is going to look like this year? And do you still have confidence in our forecast?
Yeah, so I do still have confidence in our forecast. That big slide that took place over the last couple months in 2023, that was predicated on a pretty fairly aggressive rate cutting campaign out of the Federal Reserve. The markets are expecting at least 6 rate cuts over the course of this year. Our view is maybe the Fed cuts rates 4 times. So that would imply maybe a little backup in yields on the 10-year Treasury yield. Our view is 375 to 425 to end the year. So we're right around 4% currently. So I think we're going to be in this trading range as we just talked about. This consolidation phase around 4% seems to be the level that the market continues to trade around and hover around. So 4% is probably that key level on a near-term basis. But if the Fed, I'm sorry, if the markets have to reprice any sort of Fed rate cuts, meaning if the market becomes more in line with how we're thinking about rate cuts, we could see the 10-year Treasury yield kind of hit up against that 425 level. Now, that said, if the markets are right and the Fed does cut rates 6 times this year, it's likely we could see a 350 or even lower 10-year Treasury yield. But right now, the yield curve is still pretty inverted. It's disinverted a lot over the course of the past couple of months. But 2-year Treasury yields are out yielding 10-year Treasury yields by about 17 basis points or about 0.17%. So until that normalizes, the 10-year Treasury yield is probably in this trading range for the foreseeable future. But it doesn't matter for fixed income. I mean, it matters for fixed income investors, but remember, fixed income investors get paid to wait. You get coupon payments and you get these natural price appreciation, since a lot of these bonds are trading at deep discounts to par. So even if yields don't do anything over the course of this year, they stay in this trading range. We're looking at, to your point earlier, we're looking at kind of mid to high single-digit returns out of fixed income. If yields do fall back down closer to that 350 range, it's conceivable that high-quality fixed income can generate low double-digit returns this year. So still pretty optimistic about fixed income for sure this year.
Yeah, and certainly those return expectations are consistent with our recommended asset allocation, tactically pretty close to neutral on stocks and bonds. I'm going to give you a hot take here, Lawrence, and you tell me if this is crazy. So many people expect 4 rate cuts or less this year, right? You hear them, all day long on the financial news stations. You see it in, articles in, CNBC, Bloomberg, everywhere you look. Nobody's really predicting 6 rate cuts. So my view here is that if we get 3 or maybe 4 and the economy just muddles through, that's basically consensus, which tells me that the market shouldn't be too volatile. The bond market shouldn't be too volatile if we get 3 cuts, rather than a market that's disappointed and throws a temper tantrum because we didn't get 6. What do you think about that?
I think, I mean, that big slope, that big fall in yields that we saw towards the back end of last year, that was predicated on 6 cuts. So I do think that if we only get 3 or we do get 4 cuts as we expect, I don't see us retesting 5% on the 10-year Treasury yield. I think the only way we get back into that 5% level or slightly below that is if there's a resurgence of these inflationary pressures that look to be somewhat under control currently. But if we only get 4 or perhaps 3, we could get 425 on the 10-year Treasury yield. I don't think that we're going to see a violent spike higher because the markets are expecting rate cuts. Now, if there are no cuts this year, which is not our base case, then we perhaps see a temper tantrum out of the bond market that we saw, kind of like reminiscent to 2013, where we saw yields spike higher. But I mean, to your point, a lot of the movement in the 10-year Treasury yield has probably already taken place. It's really this consolidation phase. But we'll have to see what happens with the Fed and the data on a go-forward basis.
Right. Part of our somewhat constructive view on equities is based on our expectation that the bond market will be pretty calm. So if we do get 3, 4 rate cuts rather, that suggests maybe that we'll have a pretty calm bond market, even if yields drift a little bit higher. So Lawrence, let's shift to munis. Again, we get a lot of interest in munis. I mean, I think we'll probably get more interest next year when we determine whether we're going to see tax cuts extended, right? The Trump tax cuts of 2016, I guess, or 2017. Some of them are expiring in 2025. So that'll probably put a lot of attention on the value of that, the tax-friendly status on munis. But they're getting a lot of attention now. So why don't you walk us through your outlook here? Because I'm sure a lot of our listeners are interested and own some munis.
Yeah, for sure. So it is an area that I do agree that I think it's going to the interest is going to pick up this year, partially because of the solid returns that were generated last year. So if you think back to 2023, the broad muni market index was up over 6.4% for the year, which probably pulled forward some returns on a go-forward basis, but we still think that there's value within the muni market. Taking a step back, the way we kind of look at markets here in LPL research, we have really a 3-factor framework. We look at valuations, technicals, and fundamentals. The valuation story is an interesting one for the muni markets. So even despite the strong performance that we got last year out of the muni market, yields are still above longer term averages. So from a valuation perspective, we do think that there's, again, value within the muni market. Starting yields are about 3.3% on the index, 5.5% on a tax equivalent basis. To your point earlier, Jeff, about the tax favored status of munis, when you do adjust for the tax benefits, I mean, you're getting a 5.5% out of muni securities, which is, again, a pretty decent and attractive yield given the remaining things we're going to talk about with fundamentals and technicals. So valuations are still pretty attractive, despite the fact that we did see strong performance to end the year last year. The next slide, we do look at the fundamental backdrop for the muni market in general, in aggregate. It's kind of hard to look at an asset class as diverse and is idiosyncratic as the muni market. But when we do look at things like tax collections from these state and local entities, you're still looking at tax revenues that are above pre-pandemic levels. We're probably past peak fundamentals, but we do think that there's still a lot of cash on balance sheets. There's still a lot of rainy day funds that are available for a lot of these municipalities in the event of a kind of an economic slowdown. And then you also still have strong labor and real estate markets that should help continue to support these revenues. So from a fundamental perspective, the probability, we would argue, of any sort of credit event or any sort of default activity is pretty low. It's generally pretty low for munis in general. If you look at kind of default activity of munis versus, say, investment grade corporate issuers, you get a significantly better default rate out of munis than you do for, call it, taxable corporate bonds. Moody's is a rating agency that updated its default rate analysis recently, and over the course of the past, call it, decade, from 2013 to 2022, the default rate for muni securities was just above zero. It was about 1.9 or 2% for taxable corporate bonds cumulatively. So it's even better on the high yield market. The high yield muni market default rate is around 4% cumulative versus around 33% for high yield corporates. So you have a lot better credit profile out of the muni market than you do in some of these other taxable markets. And combined with the starting valuations in this market, we do think that there's a pretty good opportunity for a lot of these investors. And then finally, looking at the technical landscape, the technicals within the fixed income markets are a little different from kind of how we talk about technicals in the equity markets. When we talk about technicals, from my view, I mean, Adam does his thing for sure and has his approach that is additive to our process for sure. But when I talk about technicals, it's usually supply-demand dynamics. And if you look at the supply-demand dynamics within the muni investors, this is likely going to hold the key to what performance is going to look like in 2024. We've had a rash of outflows, which we're showing on the screen right here. Over the course of the past, call it year and a half, there was about $120 billion that's been taken out of the muni market on the mutual fund side, which is the predominant investor in muni securities. About $120 billion that's been taken out of that market. That has put upward pressure on yields, downward pressure on prices. So that has not been supportive to markets. But given the returns that we saw out of the market last year, I do expect that supply demand dynamic to shift a little bit. The supply within the market is still going to probably stay a little muted. So if we do get investment back into mutual funds, we could get a pretty decent tailwind for prices, which would obviously help performance over the course of this year. So bottom line is that valuations are still attractive, fundamentals are still strong, and perhaps with this improving supply-demand dynamic, 2024 could be another good year for munis.
Sounds like a pretty upbeat assessment. When you add the tax benefit here, sounds to me like for taxable accounts, this should be a good chunk of your fixed income allocations.
And remember, I'm a fixed income guy, so I'm a glass half empty kind of guy all the time. So my enthusiasm for the asset class, I think, is pretty telling.
Notable. And although your football team won, so maybe you're coming into this recording with a little more optimism, we'll say.
Good point.
So thanks for that, Lawrence. Let's get into earnings season. Got a lot of attention late last week when the big banks reported. I think the best way to describe it is messy. They have these big charges to replenish the FDIC bank insurance fund. Remember those assessments were effectively announced when Silicon Valley Bank failed last year and Signature Bank. So this is a really big chunk of earnings. So if you back out those charges, it's about a 2% bump to S&P 500 profits overall. So right now we're kind of tracking to flat. This chart shows 1.3%, which is before all those bank results were factored in. So if we're flat, you add 2 points for the bank charges, roughly, then add 3 points of upside, which is the typical amount of upside, you get to 5. So we'll say 5% is probably a reasonable target for earnings growth in the fourth quarter. The reason maybe to be a little bit more optimistic than that is that the economy held up well. Actually, 2 reasons. The economy held up well in Q4. We're tracking the 2% GDP growth, and the dollar is weak, as I mentioned earlier. So, that says maybe we'll get, I don't know, a little more than 3% upside. Probably not much, though, because the economic surprise indexes have deteriorated. So that suggests maybe analyst estimates at the start of the quarter were a touch too rosy, right? And then we also have more of a services economy. The S&P 500 profits are more of a goods focused, earnings, and suggests that when you have less manufacturing activity and we're making less stuff, right, at least relative to services, that maybe earnings aren't quite as strong. So that's you throw all that together, maybe it suggests the average amount of upside of 3 points is about what we'll get. Probably more importantly is we're starting this upward trajectory. So we certainly don't think we're going to get double-digit earnings growth like this in Q4 of 2024. Consensus is now 19%, but we could see a ramp up and maybe end the year with high single-digit earnings growth when all is said and done. A big driver of earnings growth this quarter is going to be the Magnificent Seven. These numbers are really remarkable. I'm sure many of you had already anticipated that these big tech names were going to be a big driver of earnings. We know they're growing faster than most companies, but I think you'll still find these numbers striking. The average, if you collectively look at the Mag 7, right, and we list them down here at the bottom: Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. If you collectively look at earnings growth for Q4 for just those names, it's 46%. Look at the earnings growth for, these are consensus estimates for Q4. Earnings growth for the other 493, -7. Okay, so it's fair to say all of the earnings is going to come from the big techs. So this is why we don't think that the big techs really have to roll over significantly. I mean, Apple shares have had a little bit of a bumpy start to the year, probably more for idiosyncratic reasons. But overall, we think the Mag 7 is well positioned to generate solid returns this year, and it makes us comfortable. This earnings growth outlook makes us comfortable still overweighting growth relative to value. Also note, profit margin expectations this quarter are quite negative. So this is maybe a reason to expect a little more than that 3 points of upside that we typically get. The bottom-up analyst consensus is looking for a 110 basis point decline in net profit margins quarter over quarter. That would actually take margins down to levels we haven't seen since the pandemic, since late 2020. So that feels a little bit too pessimistic to us and maybe suggests that, efficient management of costs can, enable companies to beat estimates at a pretty solid clip. So maybe we'll get to 6% earnings instead of 5%. We'll see. Last thing, guidance always matters more than, the actual earnings results looking backward. So we'll be watching estimates closely to see where they move as companies report. By the way, we only get 24 companies, I think, this week. So it's going to be a pretty quiet week. It's really in 2 weeks, right at the end of the month, that we'll get the barrage of results, including the start of the big tech results. So in February, we'll be watching really closely to see what happens with estimates. They've been incredibly resilient for really the past year. 243 in S&P 500 earnings for 2024. The bottom up. So that's the bottom up consensus. If you take every analyst's estimate for each individual company, roll them all into one number, that's how you get to that $243 number. But if you ask strategists that look at the top down, like what I do, you end up with 233. So I'd say that 233 is really what the market's trading on more than the 243. It actually makes stocks look a little more expensive now. So the point here is don't get too alarmed if those estimates come down. They almost always come down, about 90% of the time. And it's really that 233 or LPL Research's forecast of 235 that we want to maintain confidence in as we go through earnings season. So that's just a quick view. Anything to add to that, Lawrence, before we get to the week ahead?
No, but to your point earlier about the earnings season just starting and kicking off here, it's going to be, which we'll talk about in a second, given the lack of the economic news, it's going to be of interest for equity markets as well as the fixed income markets. Remember, a lot of these companies issue bonds as well, and if companies miss, not only do their stock prices are impacted, their bond prices are generally impacted as well. So something I'm paying attention to on the fixed income side as well.
I'm sure bond investors were paying close attention to the real estate impact, particularly office real estate impact on those big banks last week. There was a little bit of a drag there.
For sure.
So good stuff, Lawrence. Let's preview the week ahead. I mean, I just think you just mentioned it's kind of a slow week. I mean, retail sales are important. It's a meaningful chunk of consumer spending. And we know consumer spending is about 70% of the economy. So retail sales really matters, especially since it's the holiday shopping season. But you're probably not going to see any big move off of the recent trends. And the recent trends have been that consumers continue to spend. So no reason to expect anything different in December. I guess the housing data is interesting. I mean, there's tight supply, so values are resilient, right? Home values. And you're not seeing a lot of turnover because of that low inventory. There's not a lot of activity in terms of existing home sales, but we're actually seeing some building, because inventory is tight. Buyers who want new homes in many cases are just having to build them. So that's been a pretty good environment for home builders. pretty good environment for housing starts and building permits. So that's this week, which maybe will be interesting. Anything else here, Lawrence, that you think people should be watching?
One thing about the housing market, there could be some eventual relief in that market. Obviously, mortgage rates get priced off of things like the 10-year Treasury yield. So as the 10-year Treasury yield falls, mortgage rates come down too. So we could see some refinancing activity. Right now, the refinancing market is effectively shut. No one's refinancing their mortgage. But as interest rates fall, you could see some of that activity pick up. The only other thing that I would add here is that uh, there is Fed speak this week. Chair Powell is not speaking, but there's a number of other influential Fed speakers out there this week. So if there's ever an opportunity for the Fed to push back on the number of rate cuts that are getting priced into the market, this is the week to do so. So we'll see if they actually take advantage of that and push back on those rate cuts. Otherwise, the market is going to do what it's going to do and keep pricing in these rate cuts.
Yeah, good point there. I'll also watch the University of Michigan survey of consumer inflation expectations. That has been a little bit market moving at times when it's been, a big mover in either direction. So, hopefully we'll see something three, maybe even a little bit lower than 3% out of that survey. But yeah, otherwise it's a pretty quiet week, and markets will be focused on earnings. There's certainly politics to focus on. Trump runaway winner of the Iowa primary. We'll have to see what happens in the New Hampshire primary next week. Probably, I mean, it's clear that Trump is in a strong position, but we'll see what happens with second place. Haley seems to be the favorite heading into New Hampshire to at least be second, if not first. We'll have to see. In the past, we've seen, as I'm sure many of you know, some strange things happen between Iowa and New Hampshire. In fact, little correlation between what you see in Iowa versus New Hampshire. So there'll be a lot of politics certainly this week. And then the Taiwan elections over the weekend were interesting. I would say it was kind of status quo, where the pro-independence party maintained the presidency, but not parliament. So it's kind of a gridlock status quo outcome where you're going to continue to see tension. Clearly, China wants to, effectively absorb Taiwan, one China and all that, just like we saw with Hong Kong. At some point, that might result in military aggression. We'll have to wait and see. That is a very big geopolitical risk for 2024 and maybe 2025. We'll have to see. But I guess at least for now, you could argue for markets, gridlock is good. So I think that'll be something else you'll hear a lot of folks talk about this week, and is probably a key reason why we think it's definitely a key reason why we think people should be careful with emerging market equities in China or heavily tied to China. So I think those are really the key events to watch for this week, or maybe just digest frankly, for today. So any closing remarks, Lawrence, before we wrap?
Just go Bucks.
Go Bucks. All right. I'll close with go Chiefs. Selfishly, we'll cheer on our football teams with our closing remarks. So everybody, thanks for joining. As always, we greatly appreciate your support of LPL Market Signals. We'll be back with you next week. Thanks so much, Lawrence, for offering your insights on the muni market and many other things. Take care, everybody. Have a great short week, and we'll see you next time. Take care, everybody.